guests available. So make sure you're listening to them and make sure you encourage everybody you know to listen to them. Brooks York is apparently having a bit of a technical difficulty, so he won't be joining us, I don't think, today unless he manages to pop on here towards the end. We're kind of in an interesting time right now. We're in a little bit of a case of limbo. We haven't planted anything yet. We haven't made any real decisions. There hasn't been any ideas about what acreage is going to be. That's going to be the conversation point that really drives the market between now and until probably mid-April. So we have a Brazilian crop coming, and we know that that's going to be large, and that's very well baked into the cake. That's been very well documented. The questions about Argentina are a bit of a problem, so we'll see how that plays out. But one thing you can count on with a pretty high degree of certainty, the extra production in Brazil will outpace any losses in Argentina. So, with that being said, we're going to do a quick news review. We're going to go over some inflation numbers. We're going to talk about inflation and interest rates, and then we're going to take a quick technical review of the market. I've been out on the road doing a lot of meetings, so my regular schedule of what I put out as commentary has been interrupted, and that happens this time of year sporadically. But that'll probably be over when we get to the first or second week in March. So with that being said, we're going to go ahead here and share screen here. And Lynette or Ashley, can everybody see this?
Yeah, looks good.
Okay, very good. So we had a set of numbers this week. We had some come out on Tuesday, and we had some come out number here came out at 6.4%. Last month it was 6.5%, and the street was looking for 6.2%. So that number did come in a little hotter than expected. Moving down to the information that came out today. Today we got the producer price index. What this measures is the wholesale cost of goods. This measures things like energy, consumer goods as they are coming to market. So think of it kind of as a wholesale inflation number. And these two, we got news here, and it's a surprise of not the kind we like. If we look at this number, ex food and energy month over month, we were 0.5 higher for the month, matching what the CPI number was, which these two don't necessarily have to correlate. But again, it was 0.1 the month before, but revised up to 0.3. The year-over-year number came in at 6.0, which, yes, that was an improvement over the 6.2 last month and a revised 6.5 figure, but a big miss from the 5.4% number. This can mean that we're going to see more action from the Fed, and they are probably going to try and drive interest rates higher. Now, that is something that's a concern if you need operating lines. It's something that could hurt overall demand. It's something that obviously has implications for growth in the economy, but thus far, the economy has held up very, very well, and seeing these inflation numbers is somewhat indicative of that. The other big item the Fed is watching are initial jobless claims. These come out every week, and this week they came out at 194,000 versus 196,000 last week. Any number that's below 200,000 is considered positive for the economy, and we have been below 200,000 for weeks on end, actually months on end. So this is something that will give the Fed more impetus to maybe raise rates. Right now, we're looking at 2 more 25 basis point hikes over the next 2 Fed meetings, and then the market expects them to stop. If we continue to see these strong inflation numbers, however, that could mean higher interest rates. That in turn can lead to a higher dollar, and that will, put a tailwind into commodity prices. Now then, as far as particular news items today, it is Thursday, and this is Export Sales Day, and I will be putting out the export sales report. Export sales for corn came in. These are actually solid numbers. This is a little better than what the street was looking for at 1.1 million. Soybeans a little bit soft at 771, and wheat at 209 continues to be very, very weak. Soybean meal, though, at 295 is a good solid number. So export sales, while still a little bit behind, they are showing some mixed signs of improvement. And if China is in fact reopening, that will be something that will definitely um, help with the total export situation, which for a number of items we are lagging noticeably. So we're going to do things a little bit differently this morning, and we're going to take a look at the markets from a technical point of view. Usually, I do this on Tuesdays, but since I was actually in Iowa speaking to a group, we are going to go ahead and we're going to actually have a little bit of fun here, and we're going to do this live for you as soon as I can find a chart tool here. Understand what we're doing and what I'm talking about here. This is going to be a perfect example for everyone to learn exactly what I'm talking about with a number of things here. So the first thing we're going to look at here is March corn. Now these three lines across my screen are three moving averages. We have the 5-day, the 10-day, and the 20-day moving average. So what these do, these average the price over the period, which 5 days, 10 days, 20 days, in a rolling manner to give us an idea of how prices are trending. Now, the one thing about the corn market right now, and something that we've been enduring for a while now, it has been very, very neutral. Old crop corn is cheap at about 650. It's expensive at about 680, and we have really been in that pattern more or less since October, with a few obvious ups and downs. Where the market sits right now is we are trading just a smidge below these three moving averages, which is considered to be a little bit bearish. Normally, we like to see markets trading above their moving averages and moving higher. When they start to move lower, that's a sign that the market trend is beginning to change. But what I would say about this is kind of a degree of gradient, and our ability to get too far away from either one of these moving averages in corn has been very slow, so the market remains neutral. One thing about neutral markets, they don't stay neutral forever, and this tends to portend to bigger and larger moves. And if we're at elevated prices, that would tend to be lower, so we need to be concerned about that. The next item down here on the bottom is a stochastic. This is an oscillator. It uses a formula to determine whether or not a market is overbought and oversold. And you can see this example right up here. When the numbers get above this dotted line right here, that's an indication of it being oversold, or overbought, excuse me. When the lines cross, that often gives us an indication that trend may change. And as you can see right here, it worked perfectly. Predicted this little teeny tiny top in the market. And as we came down, it indicated that we had become oversold on the near term as the lines hit the bottom. And the market then proceeded to bounce again, very, very small nominal amounts. Right now, the market is trying to cross over in a little bit of a bearish pattern, but since it's neither overbought nor oversold, that is an indication that the market is really quite neutral. So we're going to move on here, and we're going to take a look at December corn at new crop, which is really of more of everybody's interest. And as you can see right now, these charts look very similar. And until we actually start getting some planting and acreage ideas, and moreover, seed actually going in the ground, the new crop will take its direction from the old crop. And again, as you can see, the chart pattern is extremely neutral. We are, however, a little bit overbought, and we are trying to cross in a bearish manner here. So that's an indication that we may see prices come down a little bit, but without any big violations. This area right here is what we would call support right around the 580 area. So the market would most likely retrace back to that level. So we have about 15 cents risk at that point, most likely until we have some fresh news. We will see the market probably bounce off of that. Moving on to the March soybeans. And here you can see the trend difference between the soybeans. The soybeans have been generally trending higher. Support for soybeans has been very good. There's always good demand for protein. Even with the chicken problems we've had, we've seen that go on. Also, the crushing formula is changing, and this is something as producers need to keep in mind, that we are going to see greater demand for soybeans because we are actually seeing an increased demand for soybean oil. The biodiesel mandate is real and it's happening. And in turn, that is elevating soybean oil prices, which has, some knock-on effects. That increases food inflation because nearly any processed food probably somewhere in its lifespan has some soybean oil in it. Even if it's just ink on the label, there's soybean oil built into a lot of things. So as that develops and we begin to crush more soybeans, we are going to see soybeans demand remain very stout domestically and internationally. Along with that, we're probably going to start finding ourselves with some excess meal, which may increase livestock production down the road. But getting back to the chart here, and we'll make this nice and big so we can see what's going on right at the moment. The 20-day moving average continues to move higher, which is good, and it's supportive. And right now we are trading just above the 10-day and trying to get back above the 5-day, which is a little bit supportive. This chart pattern right here where you see we went up, we spiked up, we came back down, and then we reversed. That is often the signs of a top, or if we see an inversion of this, that is a good indication that maybe we are making a bottom. So this chart pattern, while it's favorable, does have some heaviness to it, and we may very well find ourselves with 1550 really being the upper band for old crop. And this cross right here is a little bit bearish, but again, it happened in neutral territory, so we're not seeing anything too well defined. Moving on to the November soybeans. And here, the picture's a little more mixed. The solid uptrend that we see in old crop isn't there. This is being influenced to a great deal by what we are seeing in South America. We are going to see a lot of soybeans coming out of Brazil. They are probably going to produce 151 to 153 million tons, which is way up from last year. So there are going to be plenty of beans for everybody. Now, the pattern here is a little bit of a mess. We are technically in an overbought state, but if the blue line crosses up through the red line, that is actually a bullish signal. So you can, in an overbought situation, get a bullish signal. For that to happen, you would probably see us to need to break out of this range. And right now we are seeing a little bit of firmness in this. The fund positions are largely loaded for both corn and soybeans and the old crop. We have not gotten a COT report for the last 2 weeks due to the ion trading problem with their cyber attack in London. However, maybe this week we will finally see the report and see what the funds have done over the last couple of weeks. Most likely the behavior has been fairly neutral. The European Commission yesterday did put out their version of it, so hopefully we will be back online. Moving on to the wheat market. And the wheat market, again, here, let's get a better picture of where we've been and where we're going. The wheat market continues to find pressure, and we continue to be stagnant. And the market is caught more or less in a range, $7 at the low, $8 at the high. So a bit of a wide range, but really not breaking out of it. Again, we see these heavy top formations. We have a fresh signal here, and we've started to break back down through the moving averages, which direction when we're going through the moving averages, is very important. And when you read the report, I often allude to that because if we're coming up through them, that's a good sign. If we are breaking back down through them from the top, that obviously is a bad sign. And we're beginning to see that again in the wheat market, as every time the wheat rallies, it just seems to attract more and more sellers. Looking at the wheat in Kansas City, and again, we are doing a little bit better here. We have a little more of an uptrend. Quality wheat is going to be able to command a premium, so both Kansas City and Minneapolis can outperform on a relative basis versus Chicago. A lot of the Australian wheat, yes, we're getting a record crop out of there even after the flooding. That's the good news. The bad news is the quality of that wheat may be a little bit more variable, so that can keep these prices a little more supported. The fund position in wheat is very simple. The funds are short massive amounts of wheat. They stayed short massive amounts of wheat all the way through the rally with the Ukrainian invasion. So clearly, that position is obviously being offset by long positions in the corn market. That's something hedge funds like to do. So if they begin to back out of the corn position, meaning when we start to come in and these March contracts start to come into first notice here in a week and a half or so, the real question is, are they going to want to roll those contracts into May and June, which will be influenced by the South American production? Will they be willing to roll them into December in new crop, or will they simply exit? If they just exit, there can be some market heaviness in corn and soybeans. However, with the wheat market, if those trades, those short positions are tied to those long corn futures, we may very well see some sort of short covering rally. And how, when you hear the phrase short covering rally, what that means is this is a chart of aggregate open interest. Open interest is how many contracts actually exist. So what happens when you have a short covering rally is the price goes up, okay? And the open interest actually goes down. That means the market is getting smaller, meaning those short positions are being forced into the market and they're coming in and they're buying them back. So the size of the market shrinks and the price goes up. The caveat with this is these rallies tend to be short-lived, meaning once that buying dries up, you have elevated prices. The natural sellers in the market very often come in and start selling, and that does send prices lower. And let's take a look at cotton. And cotton is seeing a bit of a struggle here. There are some problems going on distinctly with the cotton market, and we do have some fundamental issues. See, cotton had come down noticeably. We got the bounce per usual. The last bounce we've been trending, and we had been doing actually a little bit better. New crop looked a little bit better, but we are now beginning to fall apart. As we've broken down through the moving averages, you can see the moving averages are beginning to turn lower. Prices moved down and open interest dropped. So that means we are seeing liquidation in the market. What is driving this is there was an earthquake in Turkey. Turkey is one of the biggest consumers of cotton in the world. They have a massive yarn industry there, and they're a big importer from the United States. What has happened? That earthquake hit in the area where a lot of this cotton gets refined and gets turned into the stuff that makes it to the store or into clothing material. And that is probably going to be offline. Estimates are anywhere from 4 to 6 months. So that consumption, that is a natural big part of the cotton market, has been eliminated. And yes, there will be other parts of the world that can pick this up and adjust for it. That's why prices haven't completely fallen apart. But it has certainly changed the tenor of the market, and that makes this market much harder to own from a speculative point of view. And if anyone has any questions, certainly feel free to stop me and interrupt. Moving on to the other cotton market, this is a perfect example of a market making a technical breakdown. We have the moving averages all crossing, which they're crossing in a bearish manner, meaning the blue line is moving back over the yellow line. We have a technical breakdown. We're getting a sell signal down here, and the price is moving to new lows. We had a failure at the recent highs. The market tried to recover today. Now it's back on its nose. And this is an indication of the market breaking down. Something else that we tend to talk about are things like support and resistance. So if we wanted to look at support for the cotton market, You just draw a simple line right below the lows. And again, this is a perfect textbook example of a market beginning to break through support. Now, what happens with this? You have human traders who see this, and that's going to, one, it may prompt them to sell. The other thing that it does is we have a lot of algorithmic trading that goes on, a lot of AI type trading, and they look and recognize patterns. Computers are very good at doing that. And this very often will prompt some selling, not so much in the cotton market, it's not as big as some of the other ones, but certainly in things like corn and soybeans and other more widely traded items. Move on to the cattle here. Cattle market has been interesting. We have a good tug of war going on with the cattle market right now, meaning cash prices are beginning to work higher, but we're seeing cutout prices not moving up enough. So there's a bit of a push and pull in here, whether or not we're going to be able to drive cattle prices higher. Eventually, we will due to supply, but we're going to need to see prices at the grocery store actually go up. So I know that always makes me popular when I say things like that, but it is what it is. And here, the futures had done really quite nicely. From January, we had moved up from 158, up to 164 and had a pretty good bullish thing going on. However, this market moves in fits and starts. As you can see, we're starting to break down through the 5 and 10-day moving averages, which with this market usually portends a test of the 20-day. The stochastic is overbought, indicating that there may be some selling pressure. Open interest has been rising through this. There's a big, large fund position here, and those guys are willing to take profits in a hurry. So we could see the market break down a little bit over the near term. Moving on to the hog market. The hog market suffered mightily. We have been really since the start of the year and running all the way through the first week of February in a deep bear market. We had seen belly prices, carcass prices, cash prices all fell apart. And all through this, the funds were trying to trade it from either side and not having a lot of luck. The last COT report we had, they had a massive short position, and that was right about here on the 7th. So since then, we have seen prices improve. The cash market has improved, and the technical picture here is improving, meaning the moving averages have stopped going down and they're beginning to turn ever so slightly higher. We're generally trading at or above them, and the stochastics have actually given a bullish signal. So this market may be in for a reversal. There is a spring tendency in hogs in general to see prices move higher, and we're seeing some realignment. And once we get the fund positions, it'll be very interesting to see how those are playing out. Move on to everyone's favorite here, crude oil. And the crude market, we have support at $70 a barrel. That is known support. The government says they're going to buy crude oil to refill the strategic petroleum reserve at that level. And when the market gets close, it does get very, very sensitive and bounces away from there. A couple of unique things here. Right now, the chart is there we go. The chart, the market is caught right between all three moving averages, and we seem to be trying to edge our way higher. There's a particular piece of price action right here. We came down, we made a new low, we reversed off the low, and we traded higher the next 2 consecutive days. That is a very kind of a rare signal, and in this case, it's bullish. It does have a pretty high level of accuracy because we've clearly flushed out all the shorts, and we're seeing some fresh buying. So crude oil, the chart is a little bit bullish, but I think we're going to find some natural resistance. We seem to be seeing it right around the 80, 81 area. And again, natural support comes in between 70 and 72. I'm going to do 2 more markets, and then we're going to let everyone get back to everything here. We're going to look at 10-year yields real quick, the 10-year Treasury. This is a chart of the futures. This moves opposite to the futures and right now, opposite to rates. So right now we are going down. We're down 8 ticks, so interest rates are going higher. This market is becoming rather oversold, meaning interest rates may be about done moving up. We've seen rates move higher with the inflation numbers this morning, and I'll punch up the 10-year here very closely, but right now we are beginning to get oversold, and the 10-year, the actual rate on the 10-year this morning, and we are higher. We're at 384. This market had clearly, see, we're getting a little convoluence here because this chart is basically the other chart just turned upside down. As you can see, we're trading above all the moving averages. We had a very good level right around 350 here, but we did get a big bullish signal here a few days ago, indicating that rates were going higher. Right here, again, you see this down, down, hit the bottom, bounced, come back up and higher the next day. Indication, but we are getting a little overdone, so rates here probably could be capped around these highs. And the last thing we're going to look at here very quickly is the stock market, because we have a little time. So, as you can see, going back to January, it's not been the most illustrious year for the stock market last year, but this year we've actually been doing better. And we've moved up nicely. The market did get a little bit overdone in here, and we're having a little bit of a problem today, but how the market closes is really more important than how it opens. So if we do actually see some buying in here and can finish really, above the 41.20 level, from a technical picture, we can remain neutral with a little bit of a bias, where if we get some good news, we're going to go higher. But those bounces will probably be a little bit useless like that, just like these drops have been also fairly useless. So my theory for the stock market for the next 3 to 6 months is useless rips and shallow dips. So we hopefully can edge higher, or we may edge a little bit lower, but I'm not leading with any great bias either way. And stagnation seems to be, choppy stagnation seems to be where we're at with that. Let me go ahead and stop sharing. And Lynette and Ashley, did we have any questions?
No, I have not seen any questions so far.
Well, in that case, I'd like to remind everyone to listen to our podcasts. Make sure you're reading the daily commentary. Things are going to get a lot more interesting in the grain markets very, very soon. We've had, a bit of a vacation period here with elevated prices and not really that much volatility. And we know that picture will change. And with that, I'd like to thank everyone for joining us, and everyone have a great Thursday.